Namaskar and good afternoon to one and all. I, CA Deepak Chopra, on behalf of KACA, welcome you all to today's webinar, Analysis of Union Budget 2023. To address this webinar, we have with us CA Shri Naveen Khariwal, sir. Sir, I welcome you on behalf of all. The speaker for today's session requires no introduction, but it is a formality that I must adhere to. Naveen sir is a chartered accountant and is also a graduate in commerce. He comes from a family of chartered accountants. Grandfather, father, brother are chartered accountants. He specializes in direct taxes and was co-opted member of Direct Tax Committee of ICI New Delhi for the year 2021. Currently, he is a member of Central Taxes, Corporate Laws and GST Committee of FKCCI Bangalore. He is also a current member of Finance Advisory Committee of the Karnataka State Cricket Association, Bangalore, member of Study Circle, Study Group of Committee of Chamber of Tax Consultants, Mumbai. He was part of a team nominated by Bangalore branch of SIRC of ICI to represent before Honorable Justice R.B. Ishwar Committee for Simplification of Taxes. He has been a speaker at seminars organized by about 50 branches of ICI. From New Delhi to Tamil Nadu, he has traveled the length and breadth of the country. He's also been a resource person on several other forums. To sum it all, Sir is a highly resourceful person and most important of all, a very busy human being. He's been taking back-to-back sessions on budget, and in fact, as we speak, he's taking this session from Tirupati, where he will immediately after our session be addressing the CAs of the Holy Temple Town. So we thank you immensely for your valuable time. Over to you, sir.
So, thank you, Deepak. It's my privilege to address the members of Karnataka State Chartered Accountant Association. And of late, you have been doing terrific work. As I can see, a lot of workshops being organized. Latest one being successful was the Moot Tribunal, where the grand finale was held at the Law College at Nagarbabi, which went on very well. Most of the CS, told me and they complimented the present president as well as the entire committee for the great work being done. Now, let me start the presentation on this budget. Yeah. Now, it is not that I totally agree with all the proposals of Madam Nirmala Sitharaman. Wherever, I would like to give my views. I may agree and I may disagree. So exactly, I may not be able to give any marks. When you ask now, how many marks are you giving out of 10? Let me tell you, there is devil in the deep print, in the fine print. As we go, I'll tell you the pitfalls, the advantages, the pros and cons. Now, my dear friends, as you know, this is the last budget of the present NDA government and full-fledged budget. Next year would be an interim budget. So therefore, for the things to come, Madam gave a hint 10 days back itself when she told, see, I am from the middle class family. I feel the pressures of middle class. Therefore, there was a hint that there's definitely going to be something for the middle class in this budget. And, in her budget speech, she also said that, the budget hopes to build on the foundation laid in the previous budget and the blueprint drawn for India at 100. And Madam's budget has adopted 7 priorities, namely, number 1, inclusive development. Number 2, reaching the last mile. Number 3, infrastructure and development, investment. Number 4, unleashing the potential. Number 5, green growth. Number 6, youth power. And number 7, financial sector. What we are here is to deliberate on the direct tax proposals. So I will, take you through all the amendments. How many amendments are there in this budget now for direct taxes? Basically, there are 119 amendments. Nothing to worry, we can complete everything within a span of 2 hours. Most of it, if you tell 119 amendments, when I go to a substance, subsection, explanation, proviso, then it will go way beyond 170, 160 amendments. Anyway, nothing to worry. We will discuss the amendments under the following heads as per the memorandum, explanatory memorandum of, presented by the finance minister. Now, you take the budget speech. What is madam telling here? She's talking about the tax portal. Now, she's telling, as of today, the portal has received a maximum of 72 lakh returns in a day. It has processed more than 6.5 crore returns this year. Average processing period time is reduced from 93 days in a financial year 13-14 to just 16 days now. As a practicing chartered accountant, I can vouch for it because I am filing the return today. Many small returns, the return is getting processed on the same day or on the next day, and even the refund is getting credited to the account of the taxpayer. So absolutely, there is no problem. Then, and 45% of the returns were processed within 24 hours. That is what I told you. We are filing the return today. Almost the returns are, getting processed on the same day or on the next day. Now, the very first amendment, what has madam done? As expected, she has given a lot of benefits as regards the personal income tax. But let me tell you, this is only for those persons coming under the new tax regime. Now, by this, the new regime has become by default the new regime. Now, the main thing is, if you want to opt for the old regime, you have to opt in the form now. Unlike last year, we used to opt for the new regime. Now, from this year onwards, by default, you are always in the new regime unless you opt for the old regime. So, in the return, you will have to opt for the new regime. You have to fill up the consent form, which is going to be released now. Now, what is the first amendment regarding the new regime? What is she done? She's come up with 5 proposals as regards personal income tax. Point number 1, that 5 lakhs 87A rebate, what was introduced by Piyush Goyal in 2014. You remember our chartered accountant Piyush Goyal, who presented the interim budget. 5 lakh rupees has now been increased to 7 lakh rupees under new regime. Up to 7 lakhs, you need not pay a single penny of tax. Number 2, add standard deduction of 50,000 under the new regime. Up to 7.5 lakhs, you need not pay a single rupee of tax again. So these are the 2 amendments. The third amendment, what about surcharge? Now, madam has compared all our tax rate to probably UAE, Singapore, Hong Kong, etc. And she's come up with this reduction in surcharge up to 5 crores and beyond 5 crores. So what was the surcharge at 37%, highest maximum margin rate in India for a high net worth individual? My income is not more than 5 crores. Those are having income more than 5 crores. That 42% tax and plus 37% surcharge has now been drastically reduced to just 25%. That is the third amendment done here. Again, the fourth amendment is what? Till last year, there were 6 slabs in the new tax regime, which has now been reduced to only 5 slabs. And the tax exemption has been increased to rupees 3 lakhs. Please understand, 0 to 3 lakhs, it is nil now. 3 to 6, it is 5%. 6 to 9, it is 10%. Stop here. See, up to 9 lakh, you're paying just 10% tax. That means you're paying round about 45,000 rupees, which average rate is just 5%. Up to 9 lakhs, you're paying just 45,000, my dear friends, under the new regime, hardly 5%, exactly 5% average, amounting to 45,000. Then 9 to 12, it is 15%. 12 lakhs to 15 lakhs, it becomes 20%. Above 15 lakhs, it is 30%. So what happened? The 25% slab is out now. Straight away 5, 10, 15, 20. What was last year 25 is now removed. Above 15 lakhs, it is only 30%. So if you see, my dear friends, under the new regime, up to 15 lakhs, rate of tax is just average 15%. Why? Because the tax is only 1,50,000. So average rate straight away 1,50,000 divided by 15 lakhs, hardly 15% tax. So it's a win-win situation. Win-win situation for all of you, but not probably for the senior citizen. Senior citizen and super senior citizen, I will advise them to go into the old slabs only. Why? Because you are getting, see, 80C, 1.5 lakhs. On that, you save 30%. 80D, 25,000 or 50,000 as the case may be. 80D. Again, 80CCD, pension fund, another 50,000. Then again, if you are author, playwright, etc., 80QQB, up to 3 lakhs, you can claim deduction. Another, that is 30% savings will come to around 90,000. So it depends from person to person. Therefore, persons having all this income, you need to again check, compare between the old and the new. Now, my advice to the government is exempt senior citizens totally from tax. Just remove the tax above 70 years. Above 70 years, don't have any tax for senior citizens. Just leave them alone. Anyway, Easier said than done. Now, moving forward, the last amendment now, if you see, is the regarding your leave encashment. So what was the exemption on leave encashment on retirement of non-government salaried employees, which was fixed way back in 2002, when the highest pay in the government was 30,000 per month. Now, what was 3 lakhs has now been increased to 25 lakhs. So these are the amendments for your personal tax regime. Now, what is the net revenue foregone by making all these proposals? Revenue foregone as per Madam is 38,000 crore in direct taxes, including 1,000 crore in indirect taxes, total 38,000 crore foregone, whereas only hardly 3,000 crores would be additionally mobilized. Therefore, the total revenue foregone is about 35,000 crore annually. Now, moving forward, under the second amendment, the social welfare and economic measures. What is this? Please understand, he's telling promoting timely payments to micro and small enterprises. Kindly don't use the word MSME. It is micro and small enterprise only. What is she telling? You are going to make payment to these micro and small enterprises. So she's telling, if there is an agreement entered into with micro and small enterprises, then time limit to make payment to them is within 45 days from the date of agreement. In case there is no agreement, within 15 days, you have to make the payment. Now, I will allow you on accrual basis only if the payment to these micro and small enterprises is made within the end of the year, same year. No question of applying proviso to 43B, which says to be allowed in the year of payment. It is not there, sir. It is a permanent disallowance like your 3615. Here, I think, they have missed the bus. It is a very cruel, amendment made on the businessman. Point number one is the poor businessman, now MSME, I'm telling, the poor MSME guy, has to pay. For example, there is a sari shop. Example, his purchases are, say, 5 crores. Creditors are maybe 4 crores. Why is the creditor 4 crores? Is not able to mobilize funds. There is no sales. There is no business. There is a lull in the market. He has to pay them 4 crores. Why is there creditors? He's not able to make payment to them. Second point is he has to find out whether these guys are registered under your MSME. Who has to go and build the cat now? You have to go and ask them, please give me your certificate. Please give me the certificate. If you are MSME. Again, don't think that it's only the year-end payment. As and when I enter into any agreement with MSME, that 45 days or 15 days time starts. So during the year also, as and when I am entering into transaction with your micro and small enterprises, I need to make the payment to them. So these guys are heavily overburdened, the businessman, and then you are giving them permanent disallowance, which may not be correct. And in any case, if they are able to make the payment, but beyond 45 days or beyond 15 days, as the case may be, it will be result in a permanent disallowance, which is not fair to the businessman. They need to tinker the provision a bit there. Anyway, suppose 30th March, you have entered into a transaction with your micro and small enterprises, no problem. You please make the payment within 45 days or within 15 days, as the case may be. There is no question, there is no confusion telling that before the due date of filing return, I'm going to make payment. That provision itself is not there here. So these are certain reservations, although it would be helpful to these micro and small enterprises. But because of the section 15, even though there is a delay in payment, Section 15 or Section 16 of MSME Act is taking care of them. They are paying with penalty, sir. They are paying with interest. But now you are telling them I'd make permanent disallowance for the businessman, which I think is an additional, tax to be borne by them, as compared to your 3615 also. ESI and PF, employees' contribution to ESI and PF, I don't agree with the amendment principle, because they've already, even though there is delay in payment, they have made the delay as per the payment along with the interest and penalties as per the relevant ESI PF Act. And you don't want to allow this expenditure. So similarly, even this is one more headache and burden now, which has come into play. Moving further, the next amendment is Agnipath Scheme 2022. Now, what about this Agnipath Scheme 2022? It has been introduced for the armed forces by the Government of India, Ministry of Defense, basically. So there is something called as Agniveer Corpus Fund and something called as Agniveers. So there are Agniveers, there is Agniveer Corpus Fund. And what is happening here? It is like your pension fund. Central government will also contribute. Agniveer will also contribute. on this contribution, central government is giving you interest. Every damn rupee will be exempt. After 4 years, you can withdraw the money. When the Agniveers withdraw the money, they say after the completion of engagement of 4 years, Agniveer will be paid one-time Seva Nidhi package, which rupee will be exempt. Again, they have introduced 80 CCH. Under the new scheme, you can claim 3 deductions, sir. Now, earlier, what you could claim in new scheme, sir? You can claim 80 CCD, you can claim 80 JJAA. Now you can claim even 80 CCH deduction under the new scheme if you are an Agniveer. So what is the scheme? Very simple. Each Agniveer will contribute 30% of his monthly customized Agniveer package to his individual Agniveer corpus fund. Government will also contribute a matching amount to the corpus fund. Fine. Then, so there are 3-4 amendments made. A new section is introduced and 10 within bracket 12C to provide that any payment received from the corpus fund, Agniveer corpus fund, by a person enrolled under the Agnipath scheme 2022 or the nominee of such fund shall be exempted from income tax. Again, I discussed that 80 CCH is introduced to provide that any Agniveer who is enrolled in this Agnipath scheme and who is subscribing to the Agniveer corpus fund on or after 1st of November 2022 shall be allowed a deduction of whole of the amount deposited by him and also the amount contributed by central government to his account in the Agniveer corpus fund. Now, something like salary, whenever you are receiving the amount from the central government, please treat it as salary. You will be treating it as salary, and then you are going to claim a deduction. So for that also amendment is made under 17(1), so as to provide that contribution made by central government to the Agniveer corpus fund in account of individual who is enrolled in that Agnipath scheme shall be considered salary of that individual. Corresponding deduction you can claim, not an issue. Now, move forward. Yeah, in the new tax regime, we discussed 115 BAC, an individual who is enrolled in the Agnipath scheme and subscribing to the Agniveer corpus fund shall get a deduction of the government contribution to his Seva Nidhi 80 CCH. Please remember carefully. Under the new scheme, 115 BAC, what 80 CCH is allowed? What is allowed? Only the contribution of central government, okay, to the scheme. Move forward. The next amendment. Now, the relief to sugar cooperatives from past demand. This is, targeting Maharashtra as well as Mandya here. Election year, obviously. So what is happening here? There are sugar factories. What is happening in sugar factories? You are going to purchase your sugar cane. Now, these cooperative sectors, which are operating, sugar factories are operating in cooperative sector, there are 2 types of prices. One is FCP and one is SMP. So what is FCP? It is, FCP is a price paid over and above your SMP. Fine. SMP is statutory minimum price. FCP is final cane price. Statutory minimum price is fixed by the central government by virtue of the Sugarcane Control Order 1996. Now, what was happening? What is the bone of contention between the sugar factories and the department? They are telling whatever excess paid over SMP, FCP is more than your SMP. So final cane price, whatever difference is there, you have paid more than SMP. I will disallow that. In the course of assessment proceedings, I am disallowing the excess which is paid as business expenditure. Okay, on the ground that excess price paid for the purchase of sugar cane over and above SMP is in the nature of appropriation or distribution of profit and hence not allowable as a deduction. So therefore, a new clause 17 is inserted in 36 subsection 1, stating that the amount paid for purchase of sugar cane on cooperative societies by cooperative societies engaged in manufacture of sugar at a price which is equal to or less than price fixed or fixed with the approval of government. So whatever the government has fixed, I have no problem. You pay that price, please you claim it as a deduction for computing business income. There was this amendment was made through Finance Act 15 applicable on 1st of April 16 onwards. For that they are telling, I am making one more amendment in 155 subsection 19. After this 154, my dear friends, you have to go through 155. There are 20 subsections there. These are all different types of rectification again. Nobody bothers to go through 155. Up to 154, you stop. Please read 155. Now there are amendments in 155 subsection 19. What it says? Assessing officer has to allow the deduction to the extent such expenditure is incurred at a price which is equal to or less than the price which is fixed or approved by the government. So therefore, they are telling you make an application. Please make an application to the assessing officer who, on the basis of this application, will recompute the total income of the assessee for such previous year. Okay. And then the provisions of 154 also shall so far as may apply thereto, and the period of 4 years specified in 154 subsection 7 shall be reckoned from the end of previous year commencing on 1st day of April 2022. So that is a good amendment which is made. Now, increasing the threshold limit for cooperative societies for TDS. What was, 1 crore has now become 3 crores. So 194N, you knew. What is 194N? Any banking company or cooperative society engaged in the carrying on of business of banking or post office, which is responsible for paying any sum to any person, shall at the time of payment of such sum, deduct equal to a sum of 2%. Now, when there is the requirement, sir, when the payment of amount or aggregate of amount in cash during the year exceeds 1 crore rupees. However, in case of a recipient who is a non-filer, it is to be deducted at 2% on any sum increasing 20 lakhs but less than 1 crore. And then more than 1 crore, it will be 5%. So who is a non-filer? Means who has not filed income tax return for all of the 3 assessment years relevant to previous year, immediately preceding the previous year in which such payment is received. So now 194N, they have inserted a proviso saying that where the recipient is a cooperative society, only for cooperative society, for 1 crore, the words 3 crores has been substituted, and this provision will take effect from 1st of April 2023. Now, there is this penalty again now. Don't get confused here. This penalty, 269SS and 269T. If you see here, 269SS and 269T. What is 269SS and 269T? You know that any deposit or loan, etc. Any deposit or loan. And this is acceptance, 269SS, whereas 269T is repayment of loan. Now, for all others, my dear friend, it is still 20,000, except for 2 persons from this year's budget. Who are the 2 persons? PAX and PCARD. Who is a PAX? Who is a PAX? PACS, Primary Agricultural Credit Society, as well as Primary Cooperative Agriculture and Rural Development Bank. For these 2 guys, my dear friend, cash transaction with banking companies with regard to SS and T, because these guys are involved in granting loans and accepting deposits from the rural segment. So for this, they are telling what is the quantum of when they are liable for penalty on accepting loan in cash or repayment in cash as per SSNT. The limit of 20,000 is now substituted by 2 lakh rupees. Don't get confused. It's only for these 2 guys, PAX and PCARD, Primary Agricultural Credit Society, as well as Primary Cooperative Agriculture and Rural Development Bank. Okay. Since you know that the work of these 2 guys are they are providing credit facilities at the grassroots level, relaxation may be made for them under the aforesaid provisions. Moving further now. Now there are 2 reliefs, provided to your startups, basically. Relief to startups in carrying forward. Now section 79 of the Act, restricts the carrying forward and set off of losses in case of companies other than companies in which public is substantially interested. It prohibits set off of loss if there is change in shareholding. You know that as on the date of incurrence of loss, as on the date of setting off of loss, 51% of shareholding should be held, remains with the company on the last day of previous year to which the loss belongs. However, there is an exception provided in case of an eligible startup as referred to in 80 IAC. The condition of continuity of at least 51% shareholding is not applicable to the eligible startup if all the shareholders of the company, as on the last day of previous year in which the loss was incurred, continue to hold those shares on the last day of previous year in which such loss is set off. There is an additional condition that the loss is allowed to be set off under this relaxation only if it has been incurred. Here is the amendment. Only if the loss has been incurred during the period of 7 years, beginning from the year in which such company is incorporated. This 7 years is now substituted by 10 years. That is the first amendment. Okay. So additional condition, loss is allowed to be set off under this relaxation only if it has been incurred during the period of 7 years, beginning from the year in which such company is incorporated. 7 years is now substituted by 10 years. Again, you know that the IAC, 80 IAC provides certain, what is the provision of 80 IAC? It allows 100% deduction for an eligible business carried on by eligible startup for 3 out of 10 years, 3 consecutive years out of 10 years, beginning from the year of incorporation at the option of the SSC, subject to 3 conditions. One is total turnover does not exceed 100 crores. Second is you should hold a certificate of eligible business from Inter-Ministerial Board of Certification, and the startup is incorporated on or after 1st of April 16, but before 1st day of April 23, the second amendment, 1st day of April 23 is extended to 24. So these are the 2 amendments vis-a-vis the startup under 80 IAC. Move forward. Now, this is your gold to electronic receipt, EGR. What the section is saying, very simple. Physical gold, you are converting to electronic EGR. And then again, electronic gold receipt is again converted to physical gold. They are telling there is no transfer. Nothing to worry, there is no transfer. What about cost? Cost to the previous owner. Same concept. What about the period of holding? Same thing. Section 49 is amended. 2 within bracket 42 is amended. As well as, your 2 within bracket 42A, that's what I told you. HI is inserted. The holding period for a purpose of capital gain shall include the period for which gold was held by the assessee prior to the conversion to electronic gold receipt. Similarly, for the holding period for the purpose of capital gain shall include the period for which the electronic gold receipt was held by the assessee prior to conversion into gold. Moving forward. Now, what about your there are some more tax intensive to International Financial Services Center. It is continuing. You know that there is only one IFSC in India, and that too it is in Gift City in Gujarat. Nowhere it is there. Moving forward. Now there is this 10 within bracket 46. Ahmedabad Urban Society, one recent Supreme Court judgment. Again in Delhi Development Authority, recent Supreme Court judgment, etc. Because of this, they have brought in a new section 10 within bracket 46A. What is 10 within bracket 46? Exemption to certain development institutions from specified income, like, a body or authority or board or trust or commission, which has been constituted, established by state, central, provincial act, and which is not engaged in any commercial activity. So now they are telling 10 within bracket 46, Supreme Court in Ahmedabad Urban Development Society recently passed the judgment wherein it was held that the word commercial in subclass B of class 46, commercial will have the same meaning as trade, commerce, business in 2 within bracket 15. Therefore, sums charged by such notified body, authority, board, trust, etc., will require similar consideration. That is, whether it is at cost with a nominal markup or significantly higher, to determine if it falls within the mischief of commercial activity. But Supreme Court, it made a point that in respect of all the statutory authorities, board which have been established by state, central government, etc., court held that the amounts are any money whatsoever charged for public services are prima facie to be excluded from the mischief of business or commercial receipts, as their objects are basically for advancement of public functions or purposes. Therefore, now they are telling it is proposed to amend the act so as to exclude the income of a body or authority or trust or commission from the scope of 1046, and we are going to insert a new clause 1046A for their income. So what is 1046A? Same thing, sir. It applies to body, authority, board, trust, or commission not being a company established by central state government with following purposes. What are the purposes? Housing accommodation, planning, development, improvement of cities, town, etc. Regulating, developing any activity for benefit of general public, or regulating any matter for the benefit of general public arising out of the matter for which it was created. So similarly, consequential amendments also there in 10 within bracket 23C and as well as 11.7. Now, what is the purpose of amendment? Why this amendment is done? Because of the Supreme Court, which said that, amounts or any money whatsoever charged for public services are prima facie to be excluded from the ambit of business or commercial receipts, as their objects are essential for advancement of public purposes, and they should be exempted under section 46. Now, proposed amendment to provisions of section 1046 and insertion of 1046A is brought in to settle the ambiguity of providing exemption with respect to commercial receipts for providing public services. Now, move further. This is, disinvestment $70 AA. Then, yeah, very important sections are this. You are 15% now. In order to have a level playing field, they are telling cooperative society. Oh, it was 22%, 22%. Finance Act 19, two rates came, 115 BAB, that any new manufacturing domestic company incorporated on or after 1st of October 19, and which commences manufacturing production by March 23, they can opt for a concessional rate of tax of 15% without any, no deduction, no set off, no carry forward loss, no additional depreciation, etc., etc. Fine. But, and that 22% was also there, which extended to 25% with surcharge and cess, etc. Similarly, 15% with surcharge and cess extended to 17%. So they are telling manufacturing where manufacturing cooperative society is not there at all. Whereas for the company and other than manufacturing company and cooperative society, tax rates are same, 22, 22. But what about manufacturing cooperative society? Yes, they are telling we understood our mistake. So in order to provide parity, level playing field between new manufacturing cooperative societies and new manufacturing companies, by providing concessional tax regime of 15% to new manufacturing cooperative societies as well. Therefore, new section 115 BAE of the Act is inserted. Whatever conditions are there in 115 BAB, they removed the word company, they put the word cooperative society, matter ends. Ditto provisions taken, removed the word company, they put the word cooperative society as well. All conditions are similar to and applicable to the as to new manufacturing companies. Like, there is no deduction. Like your 10 AA, 33 AB, 33 ABA, 32, etc., 80 JJAA, 35, your chapter 6A, etc. Then without set off of loss or carry forward of loss or depreciation from earlier assessment year, then your 32 only will be allowed. Then this option shall be exercised only before the filing of return of income under 139(1). An option show exercise cannot be withdrawn. Again, if there is an income by such cooperative society, which is not from manufacturing of or production of article or thing, they are telling pay tax at 22%. I have no problem. Again, if there is a close connection, etc., or any arrangement of business transaction between them produces to others more than ordinary profits, take the amount of profits as may reasonably deemed, who the assessing officer. Such income shall be charged to rate at 30%. Again, if the aforesaid arrangement, it involves a specified domestic transaction, same to same in that manufacturing company, amount of profits having regard to arm's length as defined in 92F, then profits in excess of profits as determined by the AO shall be deemed to be income of the assessee and shall be calculated tax at 30%. Similarly, if there is short-term capital gain, it is crystal clear. They are telling that short-term capital gain from a transfer of capital asset on which there is no depreciation is allowable shall be computed at 22%. Now, moving forward. Yeah, what is this? No, 35D. So this is 35D. Yes, sir. Yeah. So now what was there in 35D? Basically, this amendment is made in 35D. Yes, 35D is proposed to be amended to provide ease in claiming deduction on amortization of preliminary expenses. You know this, before the company is set up or in the course of setting up, certain expenses are incurred. So the which are claimed as preliminary expenses over a period of 5 years, 1/5, etc. Condition of activities like preparation of feasibility report, project report, etc. are required to be carried out by a concern approved by CBDT is proposed to be removed. So which will bring ease of compliance to the businessman. And the taxpayer will only be required to furnish a statement in the prescribed form, which shall contain the particulars of such expenditure to claim deduction under section 35D of the Act. Move forward. Now,
So,
what about 44AD?
sorry to interrupt you, sir, but your screen
Yeah, yeah.
share is stopped. The
Oh,
slides are not
sorry.
moving.
Okay, 1 second. Is it moving now?
Yes, sir. Yes, sir.
Sorry for the. Now, 44AD. What about 44AD, my dear friends? There is one more amendment, 44AB and 44AD and 44ADA. He is telling whatever there was a turnover of 50 lakhs, 44 ADA, and 2 crores for 44 ADA. I am now increasing to 3 crores and 75 lakhs. Basically, 3 crores and 75 lakhs, subject to one rider. 95% of the receipts should be in non-cash mode. Only 5% can be in cash mode. Then there is no need for you to maintain books of accounts, no need for audit, etc. You can continue to pay happily at the presumptive rate of tax. That is all they say, nothing else. Don't get confused with that 1 crore and 10 crores, etc. That is different, sir. 44 AB. This is only for 2 crores. That is different. This is different. There should be no question on this. Law is crystal clear and there is no confusion. 44 AD, 44 ADA, turnover was 2 crores, turnover was 50 lakhs, increased to 3 crores, increased to 75 lakhs, as well as one more rider has come. 95% of the receipts should be, in non-cash mode. Then happily you can follow this. Now move forward. Again, this is 197. This lower deduction we are applying under 197. So this was for a income of a business trust under 194 LBA. This is also included. What was that 194 LBA? That business trust will deduct in deposit tax at the rate of 5% on interest income of non-resident unit holders. So the example, in case of exemption under section 1023 FE, which was allowed to notified sovereign wealth funds and pension funds. But certificate for loan deduction under 194 LBA was not could not be obtained. Why? Because it was not mentioned under 197 of the Act. So this thing is now mentioned. Now, Section 9, gift to not ordinary resident. Way back in Finance Act 2019, there was a section introduced 918 saying what? Any sum of money exceeding 50,000 rupees received by a non-resident without consideration from a person in India on or after 5th day of July 19 shall be income deemed to occur or rise in India. That is what? Received by a non-resident. So people are clever. So gift received from by a not ordinary resident. Now they're telling nothing doing. It's not only non-resident, it will be even not ordinary resident. So that was the only anomaly. 3 years they took to realize, because that any sum of money exceeding 50,000 rupees received by a non-resident without consideration. So people, they told no, not ordinary resident is not mentioned. We will take the gift. Anyway, so here now they are telling certain persons being not ordinary residents are receiving the gift from persons resident in India and not paying tax on it. In view of the above, it is now proposed to amend clause 8 of subsection 1 of section 9 so as to extend this deeming provision to sum of money exceeding 50,000 rupees received by a not ordinary resident without consideration from a person resident in India. Move forward. 1022B newspaper, agency set up in India solely for collection and distribution of news. This exemption itself is deleted now. Don't worry, section itself is deleted. Has been withdrawn with effect from 1st of April 24. Tax avoidance to distribution of business trust to unit holders. Business trust to unit, what is happening? Business trust is distributing sums to their unit holders, which are categorized in 4 categories: interest, dividend, rent, and repayment of debt. Now, interest, dividend, rent, okay. What about repayment of debt? What are they telling? In respect of distribution made by business trust to unit holders, which are shown as repayment of debt, neither the business trust is paying nor the unit holder is paying, because you are telling in the form of repayment of debt, which is actual income of the unit holder, and it's not suffering tax either in the hands of business trust or in the hands of unit holder. So therefore, they are telling this dual non-taxation of any distribution made by a business trust, which is exempt in the hands of the business trust as well as unit holder, is not the intent of the special taxation regime applicable to business trust. So therefore, there is an amendment. Obviously, 56 to 24 17C is introduced to provide that any income shall include any sum referred to in 56 to within bracket 12 of the Act. Now, moving further. Yes, removal of TDS on payment of interest on listed debentures to a resident. Now, what was 193? It provides exemption from TDS in respect of payment of interest on certain securities. Now they are telling if you don't provide TDS, what will happen? The recipient of interest does not show that income at all. Why? There is no TDS. It does not appear in 26 years. They don't deduct TDS. That fellow recipient also does not show the interest. So they are telling goodbye. I am now going to deduct TDS. Matter ends. Under-reporting of interest income by recipient due to the above TDS exemption. Therefore, I want to omit clause 9 of proviso to 193 of the Act with effect from 1st of April 2020 3. Now, this 44BB and 44BBB misuse was there. Now they realized. What was the 44BB and BBB, sir? Purely it's a presumptive scheme for non-resident guys who are engaged in the business of providing services or facilities or supplying plant and machine hire for prospecting or extraction of mineral oil, etc. And subsection 2 is telling what? How much is the presumptive rate of tax? 10% of the aggregate of amounts chargeable under the Act PGBP. So what these two guys were doing here, only for this BB and BBB, don't confuse with AD and ADA. They are telling taxpayers used to opt in and out of presumptive scheme in order to avail benefit of presumptive income and non-presumptive income. In a year when they had loss, they used to claim actual loss as per books and carry forward. In a year when they have higher profits, they use presumptive scheme to restrict the profit to 10% and set off brought forward losses from earlier years. Conceptually, if the assessee is maintaining books and claiming losses as per such accounts, he should also disclose profit as per accounts. There is no justification for setting off of losses computed as per books with income on presumptive basis. See here, the double game. Setting off loss computed as per books with income computed on presumptive basis. Now they say no question of setting off of losses. Matter ends. You cannot set off the losses. Notwithstanding anything contained, they are telling in 32.2 unabsorbed depreciation, 72.1 business loss, where you are declaring income, these two guys, BB and BBB, under presumptive taxation, please forget unabsorbed depreciation. Please forget brought forward loss. It will not be allowed to associate. Amendment take effect from 1st of April 24. Now, winnings from games. You know 194B, 194BB, 115BB. What is 194B? Your winnings from lottery, crossword puzzle, etc. Amount exceeding 10,000 rupees at the time of payment thereon, etc. You have to deduct TDS. Similarly, 194BB, same provision. That is for what, sir? Horse race. Horse racing in any race course or for wagering, betting, etc. What is 194BB? It provides, the tax on winnings from lotteries, crossword puzzles, horse races, etc. Now, what is the mischief here? The department is telling, the finance ministry is telling, it is seen that the deductors are deducting tax under B and BB by applying threshold of 10,000 per transaction and avoiding tax deduction by splitting of winning into multiple transactions, each below 10,000. This is against the intention of legislature. Again, they are telling, in recent times, there has been an increase in uses of online games. There is a need to bring in specific provision regarding TDS and taxability of online games due to its different nature, being easily accessible with the internet, etc. So now they are telling, I want to amend 194B and 194BB, saying what? That section shall be on the amount or aggregate of amount exceeding 10,000 rupees during the financial year. Second amendment, amend 194B to include gambling or betting of any form or nature whatsoever within its scope. Third amendment, from 194B, I will exclude online games. Why? I am bringing a new section from 1st of July 2023. I am bringing a new section 194BA purely for online games. That is your winnings from online games from that date. So from 1st of July 23, 194B, I am going to remove the online games, will go out of the purview of 194B. It will enter 194BA for only winnings from online games from that date. Now 194BA, applicable from 1st of July 2023. What is this? To provide TDS on net winnings in the user account at the end of the financial year. Suppose there is withdrawal from this user account during the year, then the TDS shall be done at the time of such withdrawal on the net winnings comprised in such withdrawal. In addition, they say income tax shall also be deducted on the remaining amount of net winnings in the user account at the end of the financial year. Net winnings shall be computed in the prescribed manner. Now, so if you go forward again, what about suppose the winnings are received partly in cash and partly in kind, and then the part in cash is not sufficient to meet the liability of deduction of tax in respect of whole of the net winnings, person responsible for paying shall, before releasing the winnings, as in other acts, as in other sections of the act, ensure that tax has been paid in respect of net winnings. Please be careful here, even penalty and prosecution is introduced on this section where, partly in cash, partly in kind, TDS was not deducted. Earlier, there was no penalty in the act. Prior to this financial year, no penalty, no prosecution. Now, if especially for this kind and cash, and you are not able to pay the, deduct the TDS. Now there is penalty and prosecution both. Move forward, sir. Then they are introducing this new section 115 BBJ with regard to tax on winnings from online games. So the tax on winnings from online games will be the income tax payable at the rate calculated 30% on net winnings from such online games during the previous year, computed in the prescribed manner, a rate of 30%, and the amount of income tax with which the assessee would have been chargeable had its total income been reduced by the net winnings referred to above. Move forward, sir. TCS. What about TCS, sir? About 1 about your remittance through liberalized remittance scheme and on sale of overseas tour package. So there is no change in the first two categories. What was it? Suppose I were to fund the education expenses of my daughter out of the loan borrowed from financial institution, which is defined in 80E. What is the present rate? It is 0.5%, sir. 0.5. In excess of 7 lakhs, there is no change. We are happy. 0.5%, no problem. Or for the purpose of education, I am funding the education expenses of my daughter out of not loan, out of my own funds. Or for the purpose of medical treatment, then it is 5% of the amount or aggregate of amount in excess of 7 lakhs. Here also, I think, there is no change, but the government could have tinkered here. Even for medical treatment, you are telling me deduct 5%. You want to have an audit trail, 0.5% was enough. You want to have a trail of the transactions, 0.5% was enough, sir. Even for purpose of medical treatment, I have to first pay 5% to government of India, then take the money abroad. Now, overseas tour package. This again, going to cost the tourism industry a huge cost. This also, I don't agree with the amendment. Basically, it's already 5% was there without any threshold limit, overseas tour package. There was an audit trail. It is increased to 20%, my dear friends. 20% without any threshold limit. Now, earlier it was 5%, now it has become 20%. In any other case also, they are telling 5%, what was 5% of the amount or aggregate of amount in excess of 7 lakhs has now become 20% without any threshold limit. So there, I think, she missed the bus. She wanted to have a trial, leave an audit trial, 5% was enough. Why you are increasing to 20% will impact the tourism industry very badly. Don't tell me hotel booking, etc. outside, nothing will happen. Your tickets, etc. nothing will happen. Only it should be a tour package. Then only this section will hit. Now, one more amendment is 54F. Now, what is 54F? Either subject matter of transfer residential house, I sell a residential house 1 year before the date of transfer or 2 years from the date of transfer, or within 3 years from the date of transfer, purchase a land, construct a house. Or 54F is other than a residential house. I sell shares. I sell, I sell shares, I sell jewelry, etc. And I invest in a residential house. They are telling now I'm going to cap the capital gains at only 10 crores. Therefore, capital gain account scheme also 10 crores. Just 10 crores. Which I again think, if you see earlier, 4 or 5 years back, all the founder members of companies, say TCS, Infosys, etc., distorted tax rate. Shares are sold, held as long-term capital asset. Shares are sold to recognized stock. STT suffered exempt. 1,000 crores, 2,000 crores, 10,000 crores. Capital gains were exempt. Round about 3-4 years back, when all these persons used to sell shares, totally exempt, sir. Similarly, now what they are doing now, they are telling high net worth individuals, you have sold house for 20 crores. You again invest in 20 crores 3 years down the line. Again, after 3 years, because long-term capital asset, you keep selling and keep buying, and you don't pay a single penny of rupee to the government of India. They are telling what was the purpose and intent of the section, object of the section, to mitigate the acute shortage of housing and to give impetus to house building activity. However, it is observed that the claims of huge deduction by high net worth individuals being made under these provisions by purchasing very expensive residential houses, it is defeating the very purpose of these sections. There already planning is being done. They are going to tell this house now 20 crores of Deepak has already planned. I will take in 3 names. When I sell, it will be in 3 names. Consideration will be divided. It will be, suppose it is 15 crores, 5 crores, 5 crores, 5 crores. What are you going to do? Now I'm going to gift that property. This property will be in 3 names. So anyway, what they are telling, maximum deduction can be claimed by assessee under 54F to 10 crores only. If the cost of asset is more than 10 crores, cost shall be deemed to be only 10 crores. Please understand, there is no confusion at all. So this will limit the deduction of the sections under 2 sections to 10 crore rupees. Similarly, your 54F4 and 54(2), there is an amendment with regard to deposit of capital gain account scheme. It shall apply only on capital gains on a net consideration, as the case may be up to 10 crores. Now I'm selling the property 25 crores. Indirectly, they are collecting tax on the balance 15 crores. Okay, what was the wealth tax which was abolished? Earlier, I used to claim wealth tax, 1% on the market value of the property. Now, indirectly, they are collecting the wealth tax again now. Indirectly. 20 crores I have sold. You are telling me you can't invest beyond 10 crores. Balance 15 crores, I have to pay tax. Anyway. And plus surcharge is there. That surcharge you reduce from 25%, I mean 37 to 25%. But anyway, moving forward, market linked debentures. What is this market linked debentures now? This market linked debenture is a listed security. Currently, this is being taxed only as a long-term capital gain at the rate of 10% without indexation. Finance Minister is telling, very sorry. Henceforth, they will be treated as only short-term capital asset despite the period of holding. I am not bothered about period of holding. Is it a market linked debenture? Yes, sir. Forget the period of holding. It will be now treated as only short-term capital asset. 50AA is inserted in the act. Take the full value of consideration received or accruing as a result of transfer, redemption, or maturity of the market-linked debentures, reduced by cost of acquisition, reduced by expenditure incurred wholly and exclusively in connection with the transfer or redemption of such debentures, and pay short-term capital gain tax. I am not going to consider it as a long-term anymore. What is your market-linked debenture? It's a security, basically, which has an underlying principal component in the form of a debt security, and where these returns are linked to market returns, and the underlying securities or indices and includes any securities classified or regulated as a market-linked debenture by the SEBI, basically. Now move forward. Now, very important amendment, sir, for inventory. This will give work to all the cost accountants in India. Work to cost accountants. What is that 142.1, 142.2a? You know that is special audit. What is special audit? Any stage of proceedings before him, assessing officer having regard to nature and complexity of accounts, volume of accounts, doubts about correctness of account, multiplicity of transactions, specialized nature of business activity, and interest of revenue, is of the opinion that is necessary so to do. He may, with the previous approval of PCCIT or CCIT or PCIT or CIT, direct the assessee to either or both of the following, namely, earlier, what was it? Get the accounts audited, nominated by the principal chief commissioner, etc., and you furnish a report in the prescribed form, etc. Now, this too is inserted, sir, to get the inventory valued by a cost accountant. Please be careful. Inventory valued by a cost accountant, nominated by the principal chief commissioner or chief commissioner or principal commissioner, and to furnish a report of inventory valuation in the prescribed form. So this is the new amendment made in 142.2a. Why? Because this ICDS 2, valuation of inventory plus section 148 of Companies Act also mandates the maintenance of cost records in audit by cost accountant in certain cases. Who is going to pay the fees? Who is going to appoint the auditor? Obviously the cost auditor appointed by principal chief commissioner. Therefore, fees will be paid by the SSC, and that also will be decided the principal chief commissioner, basically. And opportunity of hearing will be given, obviously, but unless it's a case of ex parte assessment or best judgment assessment. Moving forward, sir. Now, insurance policies. Again, sir, I don't agree with this amendment. If you take the insurance marketing in India is developing by 32 to 34% per annum. What will happen of all our senior citizens, sir? They have made huge insurance policies. Insurance policies basically for all the retired people, senior citizens. And because of COVID and Corona, they have paid more premiums and more insurance policies have come. Now, what the government has done till last year, they excluded that ULIP, and amount was 2.5 lakhs. This year, they are telling all other policies on this earth other than ULIP. Please see what first premium, not more than 5 lakh rupees. The 10% of sum assured is always there, sir. Don't worry about that. 10% of sum assured, 10-10D, including sum allocated by way of bonus, etc. I was coming exempt. Then came ULIP. They told nothing doing, 2.5 lakhs ULIP, it will be taxable. Now they are telling for all other policies on earth other than ULIP, please, they are telling premium is only 5 lakh rupees. Beyond that, please pay tax. Henceforth, they are telling how to pay tax. Amount received on maturity, including sum allocated by way of bonus, less premium not claimed as a deduction in earlier years. Whatever premium paid over a period of insurance policy, claim as deduction. But it should have not been claimed in different section ETC. And now you have to pay tax. Which sections are income from other sources? There is the question of any doubt here. Don't tell me all these things now. What about old policy? You are going to receive the mature produce after 10 years. No. This is not for old policies. It is prospective nature up to only from April 23 onwards. So as much as possible, make all the policies now only. After only 1st of April 23, it will be taxed 1010D. Although in principle, I don't agree with the amendment, because this is one of the, policies which will give, a guaranteed return to the senior citizen during his old age, etc. They were used to depend on this because of the inflation. But I am happy, madam, there, has done two amendments, 15 lakhs to 50 lakhs for senior citizen. And I'm also happy that MIS 4.5 lakhs has become 9 lakhs now. I'm still happy because for joint account, 9 lakhs has become 15 lakhs. So we are happy for them. But here again, many senior citizens, etc., they will be impacted by this amendment. So henceforth, is all taxable. Don't tell me, what about if I take 10 policies of 2 lakhs each? They have inserted 3-4 provisos. Even though if it is aggregate, they'll see 4 policies, 2 lakhs, 8 lakhs. So in goes beyond 5 lakhs, every policy, every receipt will be taxable on maturity. Even that has been taken care of. Only on death, my dear friends, whether you live or other policy or other insurance policy, only on that, whatever you receive will be exempt. Else, everything is taken care. They have inserted all the provisos. So no question of splitting also. It is not going to help you. Move forward. Yes, sir. Now, if you see what is the intent and purpose of government, see, the government is telling, I want to curb the exemption provided in 1010D or by investing in policies having large premium and claiming exemption. Hence, the proposal is to ensure that such provisions are not misused by the individuals. In the other way around, it is most of the senior citizens would be impacted. They should have at least considered that. Anyway, so as also I told you, India being the most populous country in the world today, government should have encouraged individuals to protect their families by opting for life insurance policies. And withdrawing the exemption merely because of it being abused by the HNIs seems to be not correct, in my opinion. Therefore, the government, may be requested to revisit the proposal. Come to 45(5)(a). They are telling alignment of provisions of 45(5)(a) with the provisions of 194(c) of the Act. What is 45(5)(a), sir? Applies only to individual and HUF. And then, it says capital gain arising to an individual HUF from a capital asset, being land or building or both. Under a JDA, capital gains will become chargeable to tax as the income of the year in which certificate of completion or your OC, etc., for the whole or part of the project is issued by the competent authority. And capital gain on this transaction, full value of consideration shall be taken as stamp duty value of his share as increased by consideration received in cash. So what they were telling, no. This section is applicable only for all those consideration received other than cash. Okay. So that was the intention. They are telling this is not the intention. Any amount, what they were inferring, that any amount of consideration which is received in amount other than cash would not be included in the consideration. They are telling this is not at all the intention of the law. Because if you see 194 IC, clearly it says that TDS shall be made on any consideration, whether in cash or in kind, under the agreement referred to in 45(5)(a), paid to the deductee in cash or by way of issue of check or draft or any other mode. Therefore, now it is proposed to amend the provisions of 45(5)(a) so as to provide that full value of consideration shall be taken as stamp duty value of his share as increased by any consideration received in cash or by a check or draft or by any other mode. We move forward. Now, this is a very welcome provision again. You are telling, I am not going to allow you to claim double deduction for interest on borrowed capital for acquiring, renewing, or reconstructing a property. What people are doing, you are claiming deduction and interest on borrowed capital 24B. You are claiming chapter 6 at deduction 80AA. You are also debiting the interest on borrowed capital either to capital account or capitalizing to cost of property in the balance sheet. Interest on capital year on year, you're capitalizing. Very good. So you are putting it in balance sheet. One fine day you sell off the property. So you take that cost of the property along with the interest capitalized, you claim double deduction. Is this the way? Interest on capital I claim throughout my life as 24B. Balance and that interest also in the accounting entry I capitalized to the property in the balance sheet and I claimed it. So common sense mandates either you claim interest as a deduction, or if you are not claiming as a deduction, you please capitalize and claim it as cost of improvement or cost of acquisition at the time you sell the property. In fact, matter went up to Karnataka High Court in Hariram Hotels Private Limited 2010, 325 ITR 136. Karnataka High Court told yes, interest can be capitalized house property and you include it in the cost of the property and claim. There is no problem. Now again, recently Bangalore bench also gave a beautiful judgment based on Andhra judgment of Andhra High Court in Gupta's case. Our Bangalore bench, K.R. Vasudevan, member has given beautiful judgment. He says very simple. To the extent of interest claimed and borrowed capital in 24B, you please leave it. Next, whatever interest is not claimed in deduction 24B, you please capitalize and please claim as cost of, you please claim it as cost of improvement at the time when you sell the property. Department has taken clue from the judgment and now they have amended. They are clearly now they are telling that what they are telling, they have put a proviso in after 48 clause 2 saying that the cost of acquisition or the cost of improvement shall not include the amount of interest claimed under chapter 6A. Very simple. Whatever you claimed in chapter 6A, don't claim here again. So therefore, 48 of the act provides for mode of computation, whatever including 24B section 80E for provide in deduction of interest payable on borrowed capital, please don't include it. Okay. Don't include 24B already claimed. Don't include 80E, which you have already claimed. Double deduction. Now, Bangalore bench of ITIT in the case of Jerry Matthews alias Kaur relied upon the above decision of Andhra Pradesh High Court. In this case, Bangalore bench of ITIT directed the tax authorities to treat the interest not claimed as deduction in section 24 of the IT Act as a cost of acquisition while computing capital gains. The proposed amendment reaffirms the observation of Honorable Bangalore bench of ITAT regarding treatment of balance interest not claimed as a deduction under section 24 or section 80EE as cost of acquisition while computing capital gains. Happily you claim 1.5 lakhs or 2 lakhs, etc. as interest on borrowed capital. Balance capital, you please capitalize in the books. Prove to the courts that yes, sir, I have not claimed this a deduction at all, sir. Neither under 24B, neither under 80EE, neither under any other provision of chapter 6A. At the time when I sell the property, kindly allow me as a cost of improvement or cost of acquisition as the case may be. The ITAT is allowed, sir. Bangalore ITAT. Clearly, you capitalize in the balance sheet and show it clearly. I have not claimed it. 100% you will be allowed. Move forward, sir. Now, what is this? Yeah, cost of improvement. You know that, the cost of intangible, etc., asset or sort of any right for which no consideration has been paid or acquisition is nil. So they are telling many legal disputes and courts have held that taxability. You know that BC Srinivasa Shetty's case, 128 ITR 294, long back, 1981. That, where the computation fails, chargeability fails, computation fails, etc., etc. What they are telling, as of today, there is no specific provision which states that cost of such assets is nil. Therefore, the chargeability of capital gain from transfer of such assets has not found favor with the courts. Therefore, they are telling to define the term cost of acquisition and cost of improvement of such assets. It is now proposed to amend the provisions of subclause 1 of clause B of subsection 1 and clause A of subsection 2 of section 55, saying that the cost of improvement or cost of acquisition of capital asset being any intangible asset or any other right other than those mentioned in the said subclause or clause as the case may be, shall be nil. Clearly now they are telling shall be nil. Applicable from 1st of April 2024. Now this is pending rectification application by interim board for settlement. Your settlement commission was there. It was replaced by, interim board for settlement. So what are they telling? There was some time limit. So what has happened? All the pending applications went to them. So with Finance Act 21, retrospective effect from 1st April 21, it abolished the settlement commission. Consequently, what happened? The interim board for settlement was constituted for settlement of applications. Subsection 9 to subsection 13 introduced in 245D to make provisions for dealing with pending application before the settlement commission. So what they said, the time limit for amending any order or filing of rectification application as per subsection 6B expires on 1st of February 2021. Then the period from 1st of February 21 till the constitution of IBS shall be for computing the time limit. After such exclusion, if the time limit available for amending the order or for making application is less than 60 days, such period shall be extended to 60 days. Therefore, as per the provisions of clause 4 of subsection 9 of 245D, period between 1st of February to 10th of August, when the order constituting IBS was issued, shall be excluded for computing the time limit. So now what are they telling? Grievances have been received from the stakeholders regarding extension of time available to the IBS under the Act to pass rectification amendment orders. Why? Because the pending application only relate to rectification or amendment of mistake apparent from record. It is now proposed that the time limit available to the IBS for passing such order may be extended in order to dispose of the pendency and to avoid further litigation. So they have extended the time for all that, 1st February 22 to 30th September 23. So this amendment is a retrospective amendment from 1st of February 21. Move forward, sir. Now they want to introduce someone like Joint Commissioner Appeals. Why? They are telling the NFSC is heavily burdened. Heavily burdened for what, sir? From past 3 years, since when the National Faceless Assessment has come appeals, sir, how many orders have you passed? I am asking how many orders you have passed. How can you tell they are heavily burdened? Last 3 years, my question, humble question to the finance minister is, how many orders have the NFSC appeals passed, sir? Other than VSVS, other than 3615 ESIPF, how many orders have you passed? It is very less if you see. The real reason I'm telling you is because the systems were not working properly. Not the question there was a dearth of NFSC appeals there. This amendment is brought in. Why? Because systems were not working properly in the last 2 years. As a practicing chartered accountant, I can visualize this. It is not that because, there was a dearth of CIT appeals there, NFSC appeals. That is not the thing. Anyway, they have introduced Joint Commissioner Appeals. There was also before 2000, there was a authority called as Deputy Commissioner Appeals. Deputy Commissioner Appeals were there. There was section 246 also in 2000. And now what the memorandum is telling? Memorandum is giving the powers of CIT appeals, powers of honorable CIT appeals, they say, has the powers to confirm, reduce, enhance, annul, cancel an order of assessment. What are you talking, sir? The word cancellation has been withdrawn from the statute. Power of cancellation of CIT appeals has been withdrawn from the statute with effect from 1st of June 2001. And in the memorandum for 2023, you are telling me CIT appeals has the power to cancel an order, which is the power available with the ITAT. ITAT cannot enhance an assessment. ITAT can very well cancel an assessment. Anyway, this is the mistake in the memorandum. So I just wanted to bring to your notice why they wrote this. They are telling the CIT appeals has the power to confirm, reduce, enhance, annul the assessment. All this power shall be with your Deputy Commissioner Appeals now. With your Deputy Commissioner Appeals, Joint Commissioner Appeals, all these powers will be given. Anyway, so they are telling because they are currently overburdened due to huge number of appeals and pendency being carried forward every year. In order to clear this bottleneck, new authority for appeals is being proposed to be created at the Joint Commissioner, Additional Commissioner level to handle certain class of cases involving small amount of disputed demand. That is not mentioned, sir. What is your small amount of disputed demand? We don't know. Let us wait and watch. What is the small amount of disputed demand? It is a joke. 250 subsection 6A. What is 250 subsection 6A? Time limit for passing order by honorable CIT appeals, pun intended. 1 year from the end of financial year in which appeal is filed. Time limit for passing intimation 143.1. 1 year from the end of financial year in which intimation is passed. I mean, your return is filed. Anyway, so years together have passed, and the appeals are stuck at the CIT appeals level. You are pressuring you pay 20% of tax, and now March has come. All the assessees are receiving that. Otherwise, we are going to attach your bank accounts, we are going to attach your properties, etc. So these are all the practical pitfalls here. Anyway, we are very happy now. They are introducing this Joint Commissioner Appeals. They're saying that we are going to dispose of all the cases expeditiously. And all the powers available to the CIT appeals will also be available to the Joint Commissioner Appeals. But the amount, what they have told, memorandum is telling small amount. We don't know what would be that amount. Let us wait and watch. Move forward, sir. Now, reducing the time for furnishing a TP report. So what is this? In the TP assessment, TPO is required to provide 30 days time to the assessee from the date of receipt of notice issued for submission of TP study document, which is prepared as per Rule 10D of the Rules 1962. So they are telling said period may further on an application made by the SSC be extended by an additional period of 30 days. Now the amendment is made that we want to reduce the time period from 30 days to 10 days, and further extension can be given for a period not exceeding 30 days. Now, rationalization of appeals to appellate tribunal. What is this rationalization of appeals to appellate tribunal? Sir, there are three sections: 271 AAB, 271 AAC, 271 AAD. What are these three penalty provisions? 271 AAB is for search. 271 AAC is for what? Your section 68, 69, 69 A, B, C, D type of additions. That quantum of penalty is, that is 10%, etc. Put in 271 AAC. What is your 271 AAD? You wait and watch. Lot of searches are happening in Bangalore now. Lot of searches is happening in Bangalore. Now the assessing officers are going to levy 271 AAD penalty, false entry in the books of account. For example, fraudulent purchases. There is a purchase without GST. GST guys would have raided, there will be a GST survey, etc. They are going to promise you, you pay tax and GST. I am not going to share the information with the department. That is the biggest joke I've heard. They are going to take that information. They are going to pass it over the department, income tax. Income tax guys will come for search. They are going to invoke 217 AD penalty, false entry. What is the quantum of penalty? Fraudulent entry, false entry. What is the quantum of penalty? 100%. I am not bothered about that. Hardly 5 to 6 line section. Come down. It says the person who made him do that false entry, that guy, that fellow will also pay 100% penalty. So he is going to tell, my CA told me, my accountant told me, my so-and-so told me. We don't know who has advised. Be careful. So they are going to tell chartered accountant sign the balance sheet. It was you who would advise fraudulent entry. For example, commission is paid 20 crores. Example, debited in the books of accounts. You have not, you have deducted TDS, etc. But it is a fraudulent entry only to reduce the tax. And those guys, the recipients of commission, have not paid GST, have not offered the same to returns. They would have shown us, say, purchase, sales, etc. adjusted there. So fraudulent, false entry, they have to prove that is different matter. 217 AD penalty may be introduced anyway. So three penalty entries are there: AAB, AAC, AAD. What about this rationalization appeals to appellate tribunal? They are telling these three penalties can now be passed by CAT appeals also. Last year we did amendment. CAT appeals can pass orders, can levy these three penalties. When they levy these three penalties, have I amended 253(1)? So now I'm telling I'm going to amend 253(1). Yes, you can also prefer against these three orders passed by CAT appeals. Anyway, when it's levied by assessing officer, you go to CAT appeals. From there, if you lose, you go to honorable tribunal. Now these three penalties which are levied by CAT appeals also now find a place in 253(1) tribunal. Illustrative appeals, you file appeal before the tribunal. Anyway, move forward. We move forward. Now authorized officer. Assistance to authorized officer. Always it was there. What is the big deal now? Why you want now? For provision related to search and seizure, authorized officer. The powers of income tax authority were always there. Requisition of service of other officers for assistance, examination of books, for documents, for custody of evidence, provisional attachment, etc. Now, my dear friend, why they are telling is due to the new technology, digitization in every aspect, including management and maintenance and of accounts, digitization of data, cloud storage, procedure of search and seizure has become, very cumbersome, etc. Use of data forensics, advanced technologies for decoding data for complete and proper analysis of accounts. Similarly, there is an increasing trend of undisclosed income being held in a vast variety of form of assets or investments in addition to immobile property. So assessing officer is not an expert. No. How can you find out? You have stored that your undisclosed asset in form of Bitcoin, example, or you have taken a costly watch, etc. We don't know how to value those assets. Valuation of such assets and decryption of information often requires specific domain experts like digital forensic professionals, valuers, archive experts, etc. In addition to this, services of other professionals like locksmiths, carpenters, etc. are also required in most of the cases due to typical nature of operations. Now, therefore, they are telling amend the provisions to provide that during the course of search, authorized officer may requisition the services of any other person or entity as approved by principal chief commissioner. Now the department has woken up. They are telling we are going to take the help of everybody. We want to now take the help of all domain experts. And then, to arrive at the undisclosed income of the assessee. Now, similarly, in the during and post search inquiries, authorized officer may make reference to any person or any entity or any value or registered by or under any law for the time being in force, who shall estimate the fair market value of the property in the manner prescribed and submit a report of the estimate to the authorized officer or assessing officer within 60 days from the receipt of such reference. Now, the searches and your survey are going to increase, sir, say from a week from now. Because now what you have to understand is even the Kormangala guys have got the power to come for survey. Don't think it's only the Queens Road guys who are going to come now. Queens Road guys, anyway, for survey and search, you need the signature of the highest authority, DGIT investigation or principal chief commissioner of income tax. Fine. But now they have also got who these Kormangala guys in Bangalore. They have also got the authority for survey. Each officer is readying one file now. Every officer is readying one file. Will be pushed to the joint commissioner, pushed to the PCIT through proper channel, and they are going to get the approval. And you expect a surge in surveys and searches in the next week. Anyway, so come here now. The timelines for completing assessment or reassessment in such cases is linked to execution of last of authorizations during such procedure in order to establish the day of conclusion of search proceedings and what constitutes as last authorization is provided in 153B. What was that last authorization? That was there in 153B. What happened? 153A, 153B, 153C is deleted from the statute, sir, for search. Therefore, if there is a search, what to do? You fall back on provisions of 148. 148, 147, 149, 151. If there is any search, you have to now file the return only under 148, etc. It is 153 ABC is not there. So that last of authorization, what was there in 153B, they have taken that and they have now put in 148 itself. Nothing to worry, because 153 ABC is no more there in the statute. Be careful, my dear friends. If they were to come on a survey from the next week, advise the client 3-4 points. I am telling you, be careful. If they were to come for survey, point number 1, in the recorded statement, in the sworn statement, please be careful while recording the sworn statement. Because if the assessing officer were to invoke 68, 69, ABCD, rate of tax is 60%, my dear friend. It is not 30%. Please, while recording the statement, educate the client and tell, yes, I am going to offer business income. Even though if there is, the undervaluation of stock, overvaluation of stock, etc., etc., try to avoid the words, request the assessing officer, try to avoid the words 68 sections, basically 68, 69, ABCD. If you consider it as a business income, rate of tax would be 30% plus surcharge plus cess, etc. Secondly, be careful. Suppose in case of a search, I'm telling, any book is found, there are 3 names, Deepak, Naveen, Pramod, etc. 10 lakhs each, cash. Now, don't think, it's that easy. I'm going to tell, the undisclosed purchases, there is undisclosed sales. So sales minus purchases, only the net profits has to be taxed. You have a, plethora of judgments. Don't worry. Undisclosed purchases, undisclosed sales, only net abstract, fine. When I take this 10 lakhs, my dear friends, imagine there are penalties of 269 ST, 269 SS, 269 T. For example, 269 ST. 10 lakhs from Deepak, 10 lakhs from Naveen, 10 lakhs from Pramod. Who Babita has received? Babita Hardware Stores. 30 lakh rupees she has received. Now what is going to happen? Anyway, 60% tax you are going to pay. Plus education cess, plus surcharge, that is 25%, etc. 100% penalty will be levied in 216 ST, sir, from the recipient. The recipients are known here. 185% will be the tax levied. Again, for example, Babita Hardware Stores, 271 AD penalty. She says, Tomia has given me this entity. She were to say in this own statement, 270 AD will also be levied. Again, 100% penalty. 217 AD can come and hit you. 216 ST may come. I don't know. From where, it depends on the search. And survey also, you have to be careful. And then be careful about one more thing. What about your books of accounts? Your books of accounts, very, very important. In the course of survey, in the course of search, your incrementing documents, etc. What about information now? Please be very careful. Last point. Now they are telling 148. They are going to follow the procedure of 148A, A, B, C, D. It's a mere ritual. Nothing is come out of this. Mere ritual, sir. Nothing is going to happen. Anyway, the department is telling if there is a search, there is deemed information. There is no question of following procedure of 148A, small a, B, C, D. In case of survey, be careful. 3 years cases will be reopened. Please, 3 years cases will be reopened today in case of survey. But it is deemed information. Though there is deemed information, they have to, should and must and mandatorily follow the provisions of 148A, A, B, C, D. Don't inform the assessing officer. Let him forget that. Let him forget it. I'll straight away take him to the High Court. You have to, should and must follow the provisions of 148A, A, B, C, D. In course of survey, I'm telling you, although there is deemed information, because it is stated in the section. So, whereas for search, they are not going to, follow that 148A, B, C, D. Anyway, be careful for survey also. 3 years cases can be reopened. Anyway, so these are all the pitfalls in practice. You have to be updated in practice. Lot of sections are there. And 271J is anyway, Damocles sword is hanging on your head. 10,000 for incorrect tax audit report, etc. Hardly this 10,000 does not matter. That is different. Now, move forward, sir, quickly. Now, meaning of last of authorization of search. I told you it was there in 153B. It has now been put into 132 itself. Why? Because 153B is deleted. So the last of authorization for search shall be deemed to have been executed in case of search on the conclusion of search as recorded in the last Panchnama drawn in relation to any person in whose case the warrant of authorization has been issued, or in case of requisition under section 132A on the actual receipt of the books of account or other documents or assets by the authorized officer. Move forward, sir. Yeah, very important, sir. Alignment of timeline provisions under section 153. Very good, sir. This is not for us, sir. This extension of provision is not for us. It is for the department guys. Why? The department guys, they went to the finance ministry. What is the due date for issue of notice under 143.2, madam? 3 months from the end of the year. Very good. So up to June, you are going on issuing notices under from the end of assessment year 143.2. Okay. What is the time for completion of assessment? 9 months from the end of assessment year in which income was first assessable. That means by December you wanted to complete the case, whereas the time limit for issue of notice on 143 is just June. So how much time I have? Just 6 months you want me to complete the case. Therefore, go on issuing notices left, right, and center. Don't give time to the assessee at all. Where is the time? Now they are telling we want to extend. So now that 9 months has now become 12 months. Okay. What was earlier 21 months, those days, the 24 months became 21 months. After 21 months, then it became 9 months. And now 9 months have again become 12 months now. They are increasing. They have increased that again. So therefore, why? Because they told, sir, 3 months is only for, issuing notices. Balance 6 months, sir, it is faceless assessment. I have to make investigation. I have to give officers the opportunity of hearing. I have to bring on record all relevant material. I have to analyze judicial position. I have to coordinate with all the technical unit, verification unit, assessment unit, review unit, different units of assessment. A lot of coordination is required. Therefore, please give me more time because I have to pass a rational and sticking order. None of it, sir, they follow. But anyway, it is now extended. So they are telling, commencing from the period of 1st of April 2022, I will now give you 12 months from the end of assessment year in which income was first assessable. Similarly, for updated return will also be taken up for scrutiny. 12 months from the end of the financial year in which such return is furnished. What if there is, even for search, 12 months, additional 12 months, my dear friends, additional 12 months have been extended. Now, what happens if they search on 15th March? After 15th of March, what are they telling? If there is a search after 15th day of March and the due date for issue of notice is 31st March only, please give me 15 more days. So they have extended that to 15 more days. Because they are telling, sir, search will happen after 15th March. I have to record sworn statements. I have to issue summons. I have to, arrive at the undisclosed income. I have to push this case to assessing officer. That fellow has to issue notice under 148. Can I do within 15 days? When you are telling me last day of issue of notice under 148, just 31st March of that year, how can I issue 15 days? Okay. Finance Minister, I am giving you 15 more days. Don't worry, correct. So, even though you issue in April, it will be deemed to have been issued on 31st of March only. Extra 15 days is given to the assessing officer. Now, move forward, sir. Yeah, reassessment proceedings. So, what about reassessment proceedings, sir? Now they are telling I am going to issue a notice under 148. I will give you only 3 months time from the end of the month in which notice is issued to file a return. Now, notice under 148 will be issued. What is the time limit for filing return, sir? 3 months from the end of the month in which notice is issued. Suppose I am not able to file. I am not able to file within 3 months. What to do, sir? They are telling, don't worry, it will not be treated as return filed under 139. Therefore, I will not issue 143.2 also. Consequential requirements, because it is deemed to be not a return under 139 of the act at all. Again, they are telling, I told you that we discussed already. Search, requisition, or survey are conducted after 15th of March. Then there is extremely little time to collate that information and issue a notice under 148 or show cause under section 148AB. Moreover, the search is conducted by the wing and notice is required to be issued by assessing officers. So all this they are telling, these are all the problems, pitfalls in search. Evidence of tax evasion may be, checked from the statements recorded or documents seized or impounded during action before 31st March. But issuance of such notice related to such information may go much beyond the due date provided due to the procedure involved. Therefore, they are telling important information related to revenue leakage cannot be proceeded on due to the paucity of time for search conducted and information obtained as a consequence of these searches in the last few days of any financial year. Therefore, if any search is done under 132 or requisition 132A after 15th of March for any financial year, period of 15 days shall be excluded for the purpose of computing the period of limitation for issuance of notice under section 148, and the notice so issued shall be deemed to have been issued on 31st March of the year. Next, they are telling I'm going to put one more proviso in 149 to provide that in cases where information deemed to be with assessing officer emanates from a statement recorded or documents impounded under survey on or before 31st day of March. Same thing, 15th day of March of such financial year, period of 15 days shall be excluded for the purpose of computing period of limitation or issuance of notice of 148 or show cause under 148AB. Okay. Then it has also been provided that impounding or recording of the statement in consequence of search or search itself should be before 31st of March only. Only extension has been provided for the time consumed in the procedure for issuance of notice of 148 or 148A, as the case may be. One more amendment under 151. Your specified authority under 151(2) shall be now principal chief commissioner or principal director general or chief commissioner or director general. Straight away, only the highest authorities now. Now, move forward, sir, quickly. 285BA, they are telling. There is a penalty now for incorrect reporting in 285BA on the concerned authorities, 271FAA, that is 5,000 rupees. Move forward. If there is any inaccuracy in reporting of statement of financial transaction submitted by a prescribed reporting financial institution, and such inaccuracy is due to false or inaccurate information submitted by the account holder, in addition to any other penalty leviable on such financial institution, if any. 271C, I told you, sir, clearly now. Penalty for failure to deduct tax at source. Now, what is happening? I told you, partly winnings, partly in kind, partly in cash, or pay the whole of tax as required, or under provision to 194B, the tax on winning sum, cost, etc., liable to penalty of a sum equal to the amount of tax he failed to pay or deduct. Similarly, 276B makes provision for prosecution of failure to pay tax to the credit of government under chapter 12D. Or chapter as required on 115O or chapter 17B, tax deduction at source. Now 194R makes provisions for deduction of tax on benefit or perquisite in the course of business or profession. 194BA is proposed to be inserted in the act to provide TDS on net winnings from online games. So again, what are they telling? Similarly, we discussed this. Net winnings are wholly in kind or partly in cash and partly in kind. Person responsible for paying the net tax to ensure that tax has been paid in respect of net winnings before releasing the winnings. So therefore, 271C and 276B. Now move forward. What is this? 196A. Okay, in order to provide relief to the taxpayers, it proposed to insert proviso to 196A. What is it? See, this is for all the, they are telling TDS would be deducted at 20% or at the rates in force provided in DTA. They want to insert a proviso now, whichever is lower. provided non-resident furnishes TRC and 10F if applicable. Again, for small salaried employees, 192A. The small salaried employees, who are drawing this accumulated balance due to an employee under employees provident fund scheme. I don't have PAN, sir. I am a small employee. They are telling deduct tax at maximum margin rate. That they are telling, no, we will reduce it by 10%. And now it will not be 30%. It will be only 20%. So still they are telling 192A, TDS on payment of accumulated balance due to an employee. I am not going to deduct tax at 20% as in other non-PAN related cases in accordance with Section 206AA of the Act instead of maximum marginal rate. Move forward, sir. Very beautiful amendment. This is also, order was passed by our Vasudevan sir in 1980. What is it? Basically now, Deepak had income. 2020, now for the deductor is following cash system of accounting. I am following accrual system of accounting. And what happened in the year of accrual? Deepak, 2 years back, he offered the income to tax. TDS he claimed in 22. Repeat, listen carefully. 20, Deepak offered the amount to tax. He's following accrual system of accounting. 22, the deductor is following, the cash system of accounting. He remitted the TDS in 22. Deepak claimed the TDS in 2022 because it's appearing 26 years in that year only. And the deductor has paid during that year only. So therefore, they are telling, don't worry, whatever they are telling, now I facilitate the TDS credit now. Amendment itself is done. In an earlier year also, if you have offered the income to tax, after 2 years you are claiming TDS, it should not stop you from not claiming TDS because long back in 2006 itself, there is an amendment in section 199, which says 199 read with rule 37B read with rules 205. What are you telling? Rule section 205. 199, what are you telling? Income is to be offered to tax. TDS is to be claimed in the year in which income is offered to tax. That year is already been removed, sir. Year in which offered to tax. Amendment is done long back, sir, 2006 now. So now anyway, they are telling year in which offered to tax. Now 199, what are they telling? Don't worry. From this year onwards, they are telling income you offer to tax. We understood the practical problem. In my view, this is a long waited amendment. They should have made long back. You have offered to tax, sir, earlier year. There is no problem. What to do? That fellow did not deduct, did not remit. I did not claim. I am 2 years afterwards, I am able to claim, but I offered the income earlier. They are telling, don't worry, file an application before the assessing officer. File an application before the assessing officer. Prove that the income was offered to tax earlier. Claim TDS this year, and you please claim TDS this year. I will allow it. Karke. So this now long awaited amendment is finally done. If you see here, representations have been received that in many instances, tax is deducted in the year in which income is actually paid to the assessee. However, following accrual method, assessee would have already disclosed this income in the earlier years in their return. This results in TDS mismatch since the corresponding income has already been offered to tax by assessee in earlier years. However, TDS has only been deducted much later when actual payment is being made. 155 subsection 20 is inserted, sir. Rectification. The assessee cannot claim the credit for TDS in the year in which tax is deducted, since income is not offered to tax in that year. It may also not be possible to revise the return of past year in which the corresponding income was included, since the time to revise the return of income for that year may have lapsed. This results in difficulty to the assessee in claiming credit for TDS. Therefore, now they have included this 155 subsection 20. They are telling, please make an application in the prescribed form to the assessing officer within 2 years from the end of financial year in which such tax was deducted at source. Act has its own limitations. They are telling only within 2 years from the end of financial year in which tax was deducted at source. Assessing officer shall amend the order of assessment or any intimation allowing credit of such tax deducted source in the relevant assessment year. It has been further provided that provisions of 154 of the Act shall so far as may be applied thereto, and period of 4 years specified in subsection 7 of that section shall be reckoned from the end of financial year in which such tax has been deducted. Further, credit of such tax deducted source shall not be allowed in any other assessment year. Amendment has also been proposed in section 244A of the Act to provide that the interest on refund arising out of the above rectification shall be for the period from the date of application to the date on which refund is granted. Amendment takes effect from 1st of October 2023. Now, move forward, sir, quickly. This regarding advance tax claimed in your updated return 139.8A. So 140B provides for a tax deducted required to be paid for opting to file return under 139.8A updated return. Subsection 4 therein provides that interest payable under section 234B in relation to the filing of updated return shall be computed on an amount equal to assessed tax or the amount by which advance tax falls short of the assessed tax. So further subclause 1 of clause A of subsection 4 provides for reduction of advance tax which has been claimed in the earlier income. Therefore, it is now proposed to amend 140B subsection 4 to provide that interest payable under section 234B shall be computed on an amount equal to the assessed tax as reduced by amount of advance tax, credit for which has been claimed in earlier return, if any. No problem. Move forward, sir. Again, 56 to 7B. Eliminate possibility of tax avoidance. What is that? Sir, a company in which public is substantially interested, receives in any previous year from any person being a resident, any consideration for issue of shares that exceeds the face value of shares, aggregate consideration for such shares as exceeds the fair market value of shares shall be chargeable to tax under that income from other sources. Put 11 rule 11 UA. But what are they telling? It was earlier word was only resident. Now they are putting even non-resident. They are putting even non-resident. Therefore, they are telling you guys to prevent generation and circulation of unaccounted money to share premium received from resident investors in a closely held company, public company in which public is not substantially interested in excess of the fair market value. However, the said section was not applicable for consideration. That is your share application money, share premium money received from non-resident investors. Now, even they have been included, sir. They removed that phrase, being a resident, matterants. Move forward, sir. What is this, sir? Yeah, this 28.4. What are they telling? Clause 4, 28.4 brings to chargeability value of any benefit or perquisite, whether convertible into money or not, arising from the business or exercise of a profession. So what was the intention of legislation? Was also to include benefit or perquisite, whether in cash or in kind. But courts have interpreted saying what? If the benefit or perquisite are in cash, it is not covered within the scope of section 28, even Mahindra and Mahindra. So that Supreme Court judgment is now laid to rest. The section is telling no. There was never this intention at all. It is now proposed to amend 28.4 to clarify that provisions of the said clause will also apply to cases where benefit or perquisite provided is in cash or in kind or partly in cash and partly in kind. Move forward, sir. Now, what about your charitable trust? There are some simple amendments in charitable trust. What are they? First, my dear friend, loans and borrowings. 42 pages is the memorandum. Don't break your head. They are giving everything, what has happened over a period of time, what is the section, then the amendment, then you will get confused because 1023C and 12, very, very simple amendment, nothing to worry, sir. 12 and 1023C, everything will be repeated. Background will be given. Then the intent and purpose of the provision will be given. And then amendments will be given. 42 pages in the memorandum. Anyway, don't worry about that. So what are the, basically, what are the amendments? There are 7, 8 amendments. What are the amendments? Basically, they are telling there is a corpus fund. You withdraw from the corpus fund. So they are telling when you make an application out of the corpus fund, it is not allowed. But when you replenish, refill the coffers of the corpus fund, you replenish, refill, you put back the money withdrawn from the corpus fund, then it will be allowed as an application. What is the time limit? Only 5 years I am giving you. You cannot sit and lifetime, I will decide karke. Corpus fund now, 5 years only. Similarly, repayment out of loan or borrowings. Very simple amendment. I borrowed now, Deepak borrowed a loan from bank 1 crore. He wants to purchase a building. He purchased a building for KSCA. They purchased a building for KSCA. Now they are telling if KSCA is a trust, for example, purchase of building will not amount to application at all. Then only repayment of loan. Only repayment of loan will amount to application. So therefore, they are telling even repayment of loan, there was no limit earlier. So now they are telling only 5 years. You repay in part by part if you want. Within 5 years, you make the repayment. I am going to allow. Else, I am not going to allow. Permanent disallowance, sir. It will not be allowed as application. No question of any confusion, sir. Law is crystal clear. I took a loan. I purchased a building. I repaid the loan. When will it be allowed, sir? Only when a time of repayment of loan, application will be allowed. Now they have added extra, what is that? 5 years only for repayment. Within 5 years of application from the corpus or a loan, then such investment, such depositing back in corpus or such repayment of loan will be allowed as application for charitable or religious purposes. Again, they are telling where application from corpus or loan did not satisfy the conditions as specified. What are the conditions, sir? That same thing, 40A IA, mutatis mutandis 40A3, the 10,000, 40 IA, TDS, etc. Then will be allowed only in the year of payment. Then all these conditions also you have to, fulfill. Move further, sir. Donation to other trust. So what are they telling? Now there are 5 trust example. One donation to other trust. That fellow gave donation to C trust. C gave donation to D trust. D gave to E. E came back to A. So they're telling everywhere you are claiming 15% enjoying life. A is giving donation to B trust 15%. B is given to C 15%. C is given to D 15%. They are telling nothing doing. Henceforth, from now on, if you are giving a donation to a charitable trust, only 85% I am going to allow. 15% I will cut immediately. I am not, you are playing around with that 15%. So you are defeating the intention of the legislature by forming multiple trusts and accumulating 15% in each layer. So therefore, nothing doing at each stage. Effective application towards the charitable or religious activities reduced significantly to a lesser percentage compared to mandatory requirement of 85%. So they are telling nothing doing. Only 85% of eligible donation made by a trust or institution under the first or second regime to another trust under the first or second regime shall be treated as application only to the extent of 85% of such donation. Redundant provisions they have removed. Okay. Move further. What are they telling? Your provisional and final, this one they are telling. What about your provisional registration? They are telling first is provisional, then your final registration. Then they are telling why you have commenced your activity. Yes, sir. Then why to go for provisional? Go directly for final registration. They are telling you have commenced your activity. Yes, sir. Then why you want to apply for provisional registration? Activity is already commenced. You have to apply for 2 registration as of today, provisional and regular simultaneously. So they are telling you directly apply if your activities have commenced, directly apply for final registration approval in such cases. Now again, violations, sir, my dear friend, in the form furnished by the trust for provisional approval, registration, re-registration, etc. They are all defective. And since the process of registration, approval, provisional registration, approval is automated, registration has been granted by CPC. At present, the approval registration and provisional approval registration can be cancelled by PCIT or CIT for certain specified violations. Now they are telling if it is not complete or if it contains false or incorrect information, then what I'm going to do? No question here. It is a violation and therefore I'm not going to grant you registration. Even if the form is defective, mind it. Move on to the next amendment. Your alignment of time limit. What are they telling? Your Form 9A or Form 10? Form 10 is for accumulation, sir. Form 9A is what? I received the donation on the last day. Or there is FD accrued interest. I'm not able to receive the money. Or I received donation on the last date. I'm not able to spend. They are telling you file Form 9A, file Form 10, accumulation of income, etc. In the audit report, you have to fill the details also. So they are telling, since the due date for furnishing a Form 9A 10 is 1 month before the due date of furnishing the ITR, auditors find it difficult to report. So they are telling, I will now make it 2 months. So your 31st October, now by 31st of August, please file Form 9A and please file Form 10. Careful, this time onwards, 31st of August, because it is 31st October example, it's audit case, 2 months. So they are telling, in order to rationalize the provisions and for filing of Form 10 9A, at least 2 months prior to the due date specified under subsection 1 of 130. It's not 10A form, sir. It is 10 only form. Mistake in the memorandum. It is Form 10. So Form 10, Form 9A. So 2 months prior to the due date specified. Now, if you do not specify, my dear friend, again, at the end of 5 years, you have to, at the end of 5 years, you have to renew. If you don't renew, don't tell me, sir, you have to pay tax on accredited income. Accredited income, you have to pay tax, maximum marginal rate. Be careful now. They are telling, I don't know. You should have renewed at the end of 5 years. Why you didn't renew? Therefore, pay tax now. Ditto provisions for 12 are now put in 1023C. All these amendments are also put in 1023C now. Move forward, sir. Again. Now, what are they telling is, if at all now return is not furnished by a trust under the 139 of the Act, or for both 11, 12 as well as for 1023C, and also, but what has happened? Then exemption will not be available. Fine, but they forgot 139(8)(a), Amendment by Finance Act 22. It provided an option to the trust to furnish updated return of income up to 2 years. So this resulted in what? Unintended consequence, allowing exemption or 11, 12, etc. And 1023C4, 1023C5, 1023C6, 1023C6A will be available to trust when they furnish the updated return of income. So now they are telling, I am now going to clarify that exemption are 11 and 12 and 1023C4, 1023C5, 1023C6, 1023C6A will be available only if the return of income has been furnished within the time allowed under 139 subsection 1 or 139 subsection 4 only. No question of 139(8)(a). That's all the amendment. What is there to take in? So sit there 1 hour, you can discuss about the trust. Come to ATG, sir. What has happened now? Modi ji is telling in the entire scheme of ATG, there are only 3 names for which donation is given for ATG. Who are they? Jawaharlal Nehru Foundation, Jawaharlal Nehru, then Indira Gandhi, and then Rajiv Gandhi Foundation. All 3 I am going to delete. All 3 names, entire family is deleted, sir, now. Entire family is now deleted from ATG. No question of giving any donation, no question of claiming ATG. So they are omitting subclasses 2, that is Jawaharlal Nehru, subclasses 3C, that is Indira Gandhi, subclass 3D, that is Rajiv Gandhi Foundation, of class A, of subsection 2 of ATG. So all these 3 donations are now removed from the statute. Move forward, sir. Yeah, Jawaharlal Nehru Memorial Fund, Indira Gandhi Memorial Fund, Rajiv Gandhi Foundation. Now, again, very important section, sir, set off and withholding of refund certain cases, 245. This 245 now is completely revamped. What is section 245, sir? 245 is substituted so as to provide that where under any of the provisions of the Act, refund is due to any person, listen carefully, refund is due to any person, the assessing officer, the commissioner, or the principal commissioner, or the chief commissioner, or the principal chief commissioner. How many people are behind your refund? May, in the lieu of payment of refund, set off the amount to be refunded or any part of that amount against any sum remaining payable under this Act by the person to whom refund is due, after giving an intimation in writing to such person of the action proposed to be taken under this section. Part of the refund has been adjusted as above, or provision, or where no amount is set off and refund becomes due to a person, then the assessing officer, having regard to the fact of that proceedings of assessment pending in such a case, a grant of refund is likely to adversely affect the revenue, and for reasons to be recorded in writing, will withhold the refund till the date on which such assessment or reassessment made. He has to inform the assessee, he has to record it in writing. But again, what about 244(1)(a), sir? Interest. Refund due to the assessee required to be withheld by AO under subsection 2. It is proposed to amend 244(a)(1)(a). How to calculate interest? Inserting a proviso that in case of an assessee where proceedings for assessment or reassessment are pending, additional interest shall not be payable to the assessee under this subsection for the period beginning from the date on which such refund is withheld by assessing officer in accordance with and subject to provisions subsection 2 of section 245 till the date on which the assessment or reassessment pending in such a case is made. Now, there are other, redundant provisions of the Act which they are now, just deleting, etc. Inconsequential. So almost we have tried to cover all the important provisions, sir. So I have completed my presentation. We can now take over the questions, if any. Because I think we have not much time.
Members, if there are any questions, you can type them in the Q&A box or the chat box. I can see one question in the Q&A box, sir.
Yes, sir.
Now that the old regime has become the default tax regime, now to opt into the old regime, is it mandatory to file the IT returns within the due date? Or can the old regime be opted for?
Now the old, yes, as you told, the default regime, new regime. In order to opt for the old regime, you have to opt for the old regime now on. Otherwise, by default, you'll come under new regime. In that form, you have to tell that you want to file under the old regime. You have to opt for it. Then only you will be allowed the old regime. Otherwise, automatically you will be taken to new regime only. And let me tell you, my dear friend, that common form is going to come now. My hunch says that, they may ask even for cash flow statement in that common ITR form. Common ITR form, they may ask you cash flow statement also or fund flow statement also. Wait for that. Yes, sir. Any other questions, sir?
No other questions as of now, sir.
Fine, sir. So I have to address one more session now on budget.
Yes, sir. So with your permission, we'll conclude the session, sir, with a formal vote of thanks.
Yes, sir. I think 3-4 participants raised hands for the reason that I had to try to cover all the amendments. Therefore, I could not allow them.
On behalf of KSCA and on behalf of all the participants, I extend a heartfelt vote of thanks to Naveen sir for delivering such a power-packed, informative and insightful speech on the Finance Bill 2023. Sir, your expertise and in-depth knowledge on the topic has shed light on the budget amendments and have helped us to broaden our perspectives. Thank you. Thank you very much, sir, for accepting our invite in spite of your busy schedule. Thank you once again, sir.
Thank you. Thank you very much.
Before concluding today's session, we have an important announcement for all. We at KSCA are also organizing a clause-by-clause analysis of the budget amendments. A series of budget sessions under KSCA Shorts series is being hosted online. Out of the budget, topics of mass interest have been broken into small segments and will be deliberated threadbare, in-depth by expert speakers in a short session spanning 30 to 60 minutes per session. The sessions will be free for all. Please visit ksca.com for more details and registration. There's just one more question which has come up. Okay.
Yeah, please. Please tell me.
Section 54, if assessee has purchased the property in 23-24 and he sells his property in 24-25, is the 10 crore limit applicable?
Sir, very simple. What are they telling? With effect from 1st of April only. With 1st of April 23 only, it's applicable. So the property is purchased 10 years back. Today you want to sell the property. What are they telling? When you sell the property, I am going to, restrict the capital gain to only 10 crores only. I am not going to allow beyond 10 crores. Your cost, basically. You would have incurred 17 crores also or 20 crores also, but they are not going to allow.
Right, sir. So with this, we've answered. There's one more which is just flown in.
Yeah, please.
Isn't the proposed change to 43B regarding payment to MSME a temporary disallowance? The deduction being allowed in the year of payment.
Not allowed, sir. It is not allowed in the year of payment. That's what I'm telling you. It's a permanent disallowance. Proviso to 43B is not there in this. Don't think that in year of payment it will be allowed, sir. It has to be paid, should and must mandatorily within the end of financial year, unless it is on accrual basis. And suppose, the transaction is entered on 31st of March, within 45 days, if there is a written agreement as per section 15 of MSME Act, or in case of 15 days without a written agreement, that's all. Don't think that you will have that added time up to the date of furnishing of income. It is not there, sir. It's a permanent disallowance. Any other question, sir?
That is it, sir. That is it all for today. Thank you once again, sir. And thank you all the participants. Thank you.